Welcome, everyone, to the Deep Dive. We're putting on our talk ticker's hats today to break down the latest earnings call from PBF Energy.
That's right, Q2 2025.
Exactly. And this one, it initially, made the market a bit nervous.
Yeah, a bit jittery for sure. Shares dropped.
But since then,
yeah,
a pretty remarkable turnaround. So we're going to unpack the numbers, the operational stuff, and the strategy that seems to have investors taking a second look.
Absolutely. It was a quarter with some definite beats on the main numbers, EPS, revenue.
Right.
But that immediate reaction was, well, cautious. Execution risk, restart timelines, that sort of thing.
So understanding why it dipped and then why it recovered so strongly, that's really key here.
It is. It tells you a lot about PBF's position right now and, maybe where they're heading. We should look at what spooked the market first and then why the story changed.
Okay, sounds good. Let's dive into those headline numbers first. Q2 2025. PBF reported a non-GAAP adjusted EPS of negative $1 L3.
Which, importantly, beat the consensus estimate. That was negative $1.19.
So, better than expected on the bottom line, even with the challenges. And revenue.
Revenue came in at, $7,475.3 million. Also beat consensus there.
Despite being down year over year, about 14.4%.
Yeah, that's right. Adjusted EBITDA was $61.8 million. And they also flagged a pretty strong operating cash flow.
Ah, yes, $191.1 million. And that included a working capital benefit, around $79 million.
Correct. Which is always, helpful for the cash position.
So good numbers overall, relatively speaking, but then the market reaction.
Yeah, the day of the call, shares fell 8.4%. Pretty heavy volume, too.
Signaling that caution you mentioned. Worries about execution, Martinez restart.
Exactly. But, and this is the crucial part, the stock didn't stay down. It's had a huge comeback since.
What are the numbers on that recovery?
Okay, so in the last month, PBF is up 28.5%.
Wow.
And over the last 3 months, up 42.5%.
Okay, so the market definitely reevaluated things, perhaps saw past the initial worries.
I think so. They started looking at the underlying value, the potential catalysts maybe.
And financially, where did they end the quarter? Cash, debt.
They finished Q2 with $590.7 million in cash. Net debt stood around $1.8 billion.
And they declared a dividend too, right?
Yep, 0.275 per share. Quarterly dividend. A sign of confidence, you could say.
Okay, let's unpack this more. That Martinez refinery, obviously a huge focus after the fire back in February. What's the latest there?
Well, the good news is that operations were partially restored in late April. That was a really critical step.
Faster than maybe some expected.
Potentially, yes. Management's now targeting a full restart by the end of this year, 2025.
End of 2025, okay.
They finished the demolition work, clearing out the damaged sections, but they did find some additional scope items during that process.
So things that needed fixing that they maybe didn't see initially.
Exactly, which has slightly, adjusted the original timeline they might have hoped for, but year-end 25 is the current public target.
In the financial side, insurance.
Big news there. They received $250 million in interim insurance payments in Q2.
$250 million, okay.
And $189 million of that was actually recorded as a gain. They also expect to negotiate further payments.
For ongoing costs and business interruption.
Precisely.
Yeah.
So that insurance recovery is a major mitigating factor for the whole incident. It really helps offset the financial hit.
Definitely softens the blow. Now, moving to something else that caught my eye. This refining business improvement program, RBI, sounds like a big efficiency drive.
It is. It's a company-wide push, not just cutting costs, but focusing on efficiency and, crucially, reliability.
And they're making progress.
Seems so. They're actually on track to beat their own targets. They're aiming for over $230 million in run rate savings by the end of 25.
$230 million run rate.
Yeah. And then looking further out, $350 million by the end of 2026.
Those are substantial numbers. Where are the savings coming from?
Well, to date, they've already implemented over $125 million in run rate savings, so they're well on their way.
Okay.
About 70% of the total savings are expected from refining operating expenses. Think energy use, maintenance practices, things like that.
And the other 30%?
That's expected to come from capital and turnaround budgets. So doing those big projects more efficiently.
And management seems confident these are sustainable improvements, not just, one-time fixes.
They emphasize that, yeah. They're apparently tracking KPIs, key performance indicators, continuously to make sure these savings stick. It's about embedding it in how they operate.
Right, changing the underlying processes. Okay, let's zoom out a bit, bigger picture. What market trends, macro factors are kind of shaping PBF's world for the rest of the year?
The outlook from the CEO was pretty interesting. They expect light-heavy crude spreads to widen in the second half.
Okay, and widening spreads are generally good for complex refiners like PBF, right? Lower feedstock cost.
Exactly. It's a significant tailwind. They can buy cheaper, heavy crude and process it into valuable products. Lowers their input costs relative to simpler refineries.
Why are those spreads expected to widen?
Partly due to global capacity rationalizations. You've got the Lindsey refinery closure in the UK, plus pending shutdowns like Phillips 66 in LA and Valero Benicia, less competition for certain crude grades potentially.
Makes sense. And what about the demand side for the products they make?
Distillates, especially diesel, were described as strong.
Strong because?
Supply-demand imbalances, basically. Inventories are low, global refinery utilization is high. It's just a tight market.
So overall, a constructive environment.
Management seems to think so. They anticipate that product demand growth will actually keep outpacing net refining capacity additions in 2025 and probably beyond.
Which should support refining margins.
That's the idea. Sets up a pretty constructive backdrop for the sector.
Okay, so given those market tailwinds and the internal RBI efforts, what does this all mean for their finances and strategic moves?
Well, first off, liquidity looks solid. They have about $2.3 billion available.
That's a good cushion.
Definitely. And their net debt to capital ended Q2 at 30%. That's right within their target range.
So the balance sheet is in decent shape.
Yeah. And they're taking steps to make it even stronger. They signed a deal to sell the Philadelphia and Knoxville terminals.
Oh, right. For how much?
$175 million. Expected to close in Q3.
Okay, more cash coming in.
Plus, they're anticipating a $70 million tax refund.
Right.
So all these moves point towards, deleveraging and keeping that balance sheet healthy. Asset optimization, too.
What about their renewables business? St. Bernard Renewables? How's that performing?
It averaged 14.2 thousand barrels per day in Q2. That was after a catalyst change.
And looking ahead?
Q3 guidance is a bit higher, 16 to 18,000 barrels per day. Profitability-wise, management called it somewhat break-even right now.
Okay. So not a huge profit driver yet.
Not yet, but they really highlighted its strategic flexibility. Being on the Gulf Coast gives them options.
Options for feedstock and where they sell the product.
Exactly. Access to different feedstocks, different markets. That optionality is valuable in the sometimes volatile renewable fuel space.
Yeah, definitely. And there was also that interesting bit about land near the Delaware City refinery.
Oh, yeah, that was quite intriguing. They're actively looking at ways to get more value from unused land around the Delaware City site.
And the idea is data centers.
That seems to be a leading possibility. They're talking with partners like Starwood Digital Ventures.
So PBF would provide the land, maybe power?
Potentially, yeah, acting as a landlord and maybe an electricity supplier. It's about leveraging existing assets, including power infrastructure, to create, new value streams. Pretty smart thinking.
Okay, let's tie this all together for investors. We saw that initial negative reaction to the earnings, that 8.4% drop.
Right. Heavy volume, lots of concern initially.
But then the strong recovery, up over 28% last month, over 42% in 3 months.
Yeah, which really suggests the market maybe overreacted initially, over-discounted those execution risks, the Martinez timing.
And now it's reevaluating the underlying story, the RBI savings, the market tailwinds, the insurance money.
Exactly. The narrative shifted from, problems to, okay, they're managing this and the underlying business looks solid.
So what are the key things investors should watch now, the catalysts?
Well, number one is definitely more updates on Martinez. Hitting that year-end restart target would be huge.
Okay, what else?
Continued proof of those RBI savings hitting the bottom line. Seeing those $230 million, $350 million numbers get closer.
Makes sense. Show, don't just tell.
Right. Also, the closing of that terminal sale, that shores up the balance sheet.
And the macro stuff.
Keep an eye on those crack spreads, especially the light-heavy differential widening and continued strength in diesel cracks. And any more news on refinery closures globally, that tightening supply is a tailwind.
So management sounded, cautiously optimistic?
I'd say cautiously constructive is a good way to put it. They know they have work to do on Martinez, and the macro picture can always change, but they highlighted the operational improvements and the savings potential.
All right, perfect time to transition to our This Is Not Financial Advice segment. Speculation time.
Okay, let's put on the speculative hats.
So think about PBF. You've got the Martinez restart, hopefully by year-end. You've got those big RBI savings kicking in, the terminal sale boosting cash, and this supportive market backdrop, wider crude spreads, strong diesel.
Yeah, it looks like a company with significant operational leverage that's about to get back to full strength just as the market conditions look favorable.
The initial skepticism, as we said, seems gone, replaced by optimism.
But the full benefit, especially from Martinez being fully back online and those RBI savings hitting full stride, that's probably not fully priced in yet, which, creates an interesting setup.
Okay, so here's our outrageous but plausible trade idea. It's bullish, playing on both the near-term execution and a longer-term re-rating.
All right, let's hear it.
How about this? A long position in PBF shares, just own the stock, combined with buying some far out-of-the-money call options, maybe something like the January 2026 $35 calls.
Okay, so core shares plus leveraged upside. Explain the thinking.
Right. The shares give you the base exposure. You benefit if they execute, margins stay good, etc. But the calls, the Jan 26 $35, those give you that leveraged pop if they really nail the Martinez restart by year-end 25 and deliver those full RBI savings into 2026.
So you're betting that hitting those milestones, combined with tight refining capacity and good crack spreads, leads to a significant market re-rating. The stock moves higher, potentially much higher, and the calls amplify that gain.
Exactly. It's a bet on management executing flawlessly on the rebuild and the savings. If they deliver, the market might finally give them a higher multiple on what could be pretty strong normalized earnings power. Hence, the outrageous but plausible tag.
High conviction required on execution for sure, but I see the logic.
So there you have it, our deep dive into PBF Energy's Q2 2025. From the Martinez challenges and the RBI cost savings,
to the asset sales, the renewables angle, and that interesting Delaware City land idea.
PBF is definitely navigating a complex environment, but they seem to have a clear plan.
And that market turnaround, from the initial drop to the strong rally, really underscores why you need to look past the headlines sometimes. Dig into the drivers, the catalysts.
We hope this breakdown helps you understand what's happening with PBF and maybe think about the broader energy sector context.
Yeah, especially with global refining dynamics shifting. It's definitely a space to watch.
And just a reminder, as always, this discussion was for informational purposes. It is absolutely not financial advice.
Please do your own research.
Thanks so much for joining us for this deep dive on PBF Energy. We hope you found it valuable, and we look forward to the next one.